Adlib is the DSP-agnostic buying platform to scale your programmatic campaigns smarter, faster, and more profitably. Adlib helps independent agencies and marketers deliver premium programmatic performance without the complexity, cost, or overhead of traditional DSPs. Their platform provides the tools, data, and automation to run enterprise-quality campaigns, from CTV and audio to geofencing and YouTube, all under one roof with zero trafficking headaches. Plus, they're not just a platform, they're your growth partner. The Adlib team helps you win new business, expand budgets, and deliver measurable ROI that keeps clients coming back. It's time to unlock programmatic. Join leading marketers worldwide who are using Adlib to deliver more campaigns with better results. Check out getadlib.com. Welcome to Open Market, a podcast about building companies in the advertising industry. I'm Joe Zappa, and I'm joined by Eric Franchi. How are you, Eric?
Doing well, Joe. How are you?
I'm doing great. Eric, today we are going to talk about a topic that should be near and dear to your heart as an Adtech VC and entrepreneur. It is essentially who's afraid of Adtech, by which I mean when I talk to Adtech entrepreneurs, they are sometimes a bit wary of being labeled as specifically Adtech entrepreneurs because their impression is that investors, especially like in the Silicon Valley ecosystem, don't necessarily love Adtech, right? Or they're afraid they're not going to get a huge exit or they're not going to get a sufficient valuation. So where I wanted to start is just asking you from your POV, is this a thing, this sort of wariness about the Adtech label on the part of entrepreneurs and investors? And should it be?
To date, it has been a thing. I think so. Adtech has a long history of ups and downs in terms of market cycles, ups and downs in terms of it being in vogue, and a checkered history in terms of generalist investors being able to pick companies that drive great returns. So again, I'm saying to date a lot because I do think that there's a second part here, which is like, why is today different and why that should be part of the conversation. But yeah, it's been typically a challenging company for startup founders to raise from generalist investors, a very challenging category for generalist investors to invest in and like have good outcomes. But there's exceptions to every rule. And there's been, like a high 9-figure and billion-dollar exits in this category and breakout IPOs and breakout public companies, including, and depending on the day, valuations for companies like the Trade Desk that are, still in the, $15+ billion and AppLovin in the $200 billion range. So it's all, it's so dependent on a number of factors, but like the best companies, the best founders always figure out a way to do it. And I get wary of trying to say you're not an ad tech company when you are an ad tech company, because that, will get shot to Swiss cheese with an investor that has, one or two, questions that probe into exactly what you're doing. And at the end of the day, I don't think it matters.
How do you think this might be changing now? Because my impression is you were suggesting that with the AI boom that's happening right now, like the ceiling might be raised.
Yeah, you stole my punchline. Yeah, there's been, and I think there's been frankly evidence of this, that things are changing. Like, look, if I lived my career on, waiting until the ad tech sector was in favor with like Silicon Valley and generalist investors, I would not have done anything. I'd be like sitting in my room for my entire career, right? So to an extent that like this kind of like doesn't matter is thought one. But then thought two, yeah, I mean, if the big firms are leaning into a category, I think that becomes interesting and a point of validation that there might be something here that's different. So over the course of the past year or so, as agentic AI has really come into play and some of these new categories like geo and all sorts of things have come into vogue, we've seen evidence of Silicon Valley like rushing in. Sequoia has backed a geo company. Founders Fund backed a creative AI platform. Like I can, rattle off a whole list of interesting companies that A16Z has backed actually a couple of ad tech companies. Like, a listing of interesting transactions that have been backed by Silicon Valley firms that might point to the fact that there's something going on here. And that something going on is a $1 trillion plus market that is being upended by AI in two ways, right? The first is all the infrastructure is being, I think, reimagined for an agentic era. And there's new and frankly existing companies that are rushing in, and every single day it seems like there's like lightning progress being made on things like agentic buying, agentic selling, ops, so on and so forth. And then on the other side of it, advertising itself is being reimagined with AI. We're recording this right before the Super Bowl 2026, and there's going to be 4 ads by Anthropic that are, kind of like challenging the notion of ads having a place in LLMs, because OpenAI announced their ad platform, and ChatGPT undoubtedly is going to be an incredible success. So I think that there's like reason to believe that this time it's different, and being an ad tech company might not be, at minimum, might not be a bad thing. At maximum, might actually be an awesome thing in the future.
Yeah, well, it's interesting, right? Because there's the question of AI boosting the efficacy of advertising, right? And that having positive impacts not only on advertisers and publishers, but on the ad tech companies that facilitate that transaction. But then there's also the question of ad tech supporting the AI native tech tools that are blowing up, right? And so that would be ChatGPT getting to 1 billion users and then saying, how are we going to pay for all this? Not every consumer is going to want to pay, as happened with Google and Meta. And so guess what? We're going to have an ad business, which of course everyone in ad tech thought would happen. And that is another reason to be bullish about the future of advertising, is that the market will grow as the products that need to be subsidized by advertising grow. And AI is going to beget a whole new generation of those massive consumer products, which, by the way, is also what happened with the 2 other biggest advertising juggernauts in the world, which are, Google in the aughts, and then Meta, which, really blew up in the 2010s.
I agree. I did a discussion earlier this week, and I was challenged with, give me some proof that AI is having any effect, positive or negative, and any effect on advertising. Is fresh in mind because Meta had their earnings announcement last week. And I was able to point to higher engagement because of AI, leading to more ad impressions thanks to AI, leading to higher CPMs thanks to AI, in a very meaningful way that Meta just pointed to with their earnings results. Now, on the other side of it, they also, I think, kind of very carefully did this to justify what is a massive CapEx that they're looking to make next year. Frankly, all of the companies are, but it's already having an effect on the big platforms. And I think it's, going to continue to create a lot of opportunity. And back to the question of like, why should, you not be afraid, in my opinion, to unashamedly call yourself an ad tech company in 2026, it's already one of the most fertile grounds for AI to completely have a positive effect. Like, I think it's a cool thing to be a company in the middle of this space.
I think something those outside the space might undersell or underestimate is that, like, advertising is just an extremely complex market, right? And that is where, as I talk to, like, for example, the Vanderhooks at Viant, that is where AI is just having such a massive impact, is that it is impossible for a human advertising trader, a programmatic trader, to take stock of the full complexity of that market and navigate it with maximum efficiency. And that is where, like, the Vanderhooks have challenged, like, the human in the loop narrative that others have been advancing and saying, look, guys, to be honest with you, obviously, yes, there will be a human sort of managing the AI, but what we really want to move toward is an autonomous advertising model where an AI trader is essentially working 24/7. And because they're working 24/7 and because they can consume, massive reams of data, they are going to outperform the human counterpart. That will make advertising more effective, which is obviously good for advertisers. They sell more stuff. That means advertisers advertise more, right? Because they're getting a higher return on ad spend. And that means publishers are able to charge more because their inventory is becoming more valuable. It's driving better results per impression.
What a wonderful articulation. Like, I couldn't have said it better. Now go back to, why should this be an exciting thing from an investor standpoint? All of these tools need to be built, right? All of these tools need to exist. And I think it ends up creating all sorts of interesting opportunities for net new companies, which again goes back to why I think, even if it's been a challenging category to pitch investors on today, there's reasons to be thinking that things are different at this point. So I think you walk headfirst into this and talk about, like, why today is different and why there's reason to believe that the future is really, really bright for ad tech companies.
So let's talk about the fundraising context specifically. So let's say you're talking to an Apurion founder. They came to you for their Series A and now they're raising a Series B. and they say, Eric, we're sort of on the, we're on the line between ad tech and something else. So we could position ourselves as being in another market. And we're sort of concerned that when we go out and try to raise this next round, investors are going to be dubious of the ad tech label. Now, we just gave them one potential option, which is you just, head high. We are an ad tech company. It's already been good. It's going to be better than ever. Here's why, right? That's one way you can go. But let's sort of take the other side of it seriously. Like, how concerned do you think they should be about that? How concerned should they be in general about getting like the highest possible valuation? And then how would you advise them to navigate that tension when they're talking to investors?
Okay, so you got 3 questions there. Make sure that we hit all of them. So if they're a Series A company looking to raise their Series B, they've already, from an investor perspective, like de-risked the opportunity. They already have figured it out. They've got customers, they've got traction, they've got attractive financials, because if they're talking to me about raising their Series B, they've, already figured out, like, I'm going to say you shouldn't raise your Series B if you don't have the profile of a Series B company, right? So let's like assume that they're best in class and they have awesome metrics. From there, the real question is, where is this next set of growth going to come from as you go from Series A to Series B to Series C, or acquisition, IPO, so on and so forth? That's where I think, being thoughtful around how you tell the story of future growth is like super important. And if, you think that it matters from an investment standpoint of like what subcategories you think start to unlock that growth, I think you can tell a nice story of where you're aligned with where the future is going. So very simply, what are the highest growth areas of your business? And do they intersect with some of the highest growth areas of the entire business, of the entire sector? Are you doubling down in CTV? Are you doubling down in commerce? Do you think there's an opportunity to unlock what you do inside of creators, right? Like there's these big, fast, kind of like swim lanes that are right in front of us where a lot of the heat is, and that are ultimately going to be like incredible ad supported categories. Can you paint the picture that these are the next set of categories for you? Or even better, can you say like, hey, these are on the roadmap. These are the sequential areas that we think are going to be like real catalysts to us. So maybe you got your start in ad tech. Maybe you built, the rails. Maybe you kind of like cut your teeth in what people think of as perhaps like the open web, the open internet, so on and so forth. Are you in those, like highest growth areas? And can you paint the picture of like growth and defensibility in this time of like real dislocation?
Yeah. So the advice as I hear it is, you take as your point of departure the reality of the business and its growth prospects, right? So I think sometimes what happens, and as a messaging and positioning person, like I often end up in this conversation, like people depart with, like, they just ask themselves, like, what is going to get us the highest valuation? Or how do we make this company as big as possible or whatever? But you really have to start with like, what has worked to this point? And then what logically is going to get us from A to B, right? So you start with the reality of the business, and then you sort of look for the intersection of the trajectory of the business and what's going on in the market. But you can't just start from like, what type of company would, get us the highest valuation? You really have to ground it in the strengths of the existing company.
Yeah, exactly. This is like bottoms up thinking. And I think as a, kind of company of that stage, there's going to be a fair amount of bottoms up thinking because you already have a business, you're already pointed in the right direction, right? Like it goes without saying that because you're in advertising, there's an enormous TAM, right? It's a $1.2 billion market out there on a global basis. It goes without saying that you should be positioned in the highest potential areas. So it's really about like how you're going to attack it. From a valuation standpoint, I get it. You want to have the highest valuation possible for a number of reasons, right? Like, number one, dilution, right? If you're going to raise, the higher the valuation, the less dilution as a founder you're going to take on. Valuation matters from a recruiting and retention and morale perspective, right? Like you want to be able to speak to, I think, metrics that are going to be attractive and show that you're a hot company and on the right trajectory. But also, I would infuse a little bit of practicality here in that this is a sector that typically doesn't have the highest valuations relative to some of the craziness that we hear with, maybe SaaS up until recently, or, kind of like consumer facing products or even like LLMs, right? Like you're not competing with companies that are, raising at $500 billion, like, OpenAI, so on and so forth. So to the extent it matters, but it's never a category that like really, really frothy valuations end up happening. And in some cases, frothy valuations from a fundraising standpoint can hurt a company.
Right. Sometimes it can be a good thing to have a more modest or realistic valuation because you don't back yourself into a corner, right? Where it's then like, okay, now, we raised at 150 million when we really weren't worth that at our Series A, and now we have to get to 500 or something by the next raise, or we're kind of screwed.
Yeah, no, I think there's something to be said for the pragmatism of that. And a lot of this goes into, kind of weird venture math and like how much did you raise at 150 million, and are there, like tons of preferences or little preferences? Like all this stuff could end up, kind of working in the wash if you have a good outcome. But I typically don't get too hung up. I counsel my founders not to get too hung up on the valuation things because, again, ultimately, if you're kind of doing the right thing, you've got a good business, you're raising the appropriate amount of money. I typically see the right valuations being assigned to these types of businesses.
From a messaging and positioning perspective, I want to say a little bit more about that problem we discussed where sometimes CEOs and executives get stuck in the situation they wish they were in and lose sight of the reality of the business. But then I also want to talk about how to bridge the gap from where you are to going where the promised land is, right? So for example, I've worked with companies who they were founded in, let's say 2010, and they are sort of based on display or native advertising. Let's say it's like a display or native advertising like SSP. Mm-hmm. And they're like, Joe, we got to be a CTV SSP because CTV is hot, right? That is the growing market in digital advertising. And so we need to be there. The problem is what a lot of companies will do in that position is they're like, well, we've kind of like put together a CTV product, but they don't have a lot of traction in CTV. And then they're like, we're just rebranding as a CTV company. The challenge is then you're competing against a lot of incumbents who their whole thing is CTV. Right? They've been doing it since the inception of their companies, and they are extremely strong in that area. And it's a really crowded market because everyone else is seeing what you're seeing, right? You're like, we're in display and we want to get into CTV because that's hot, and everyone else is seeing the same thing. So what you risk doing if you lose sight of the reality of the business and you go entirely toward where you like wish you were is that then you're the 20th strongest company in CTV. That is not a place you want to be, right? You want to be the strongest company in your category. But I empathize with the challenge that sometimes you just can't stay put, right? You can't stay where you are. And so the question becomes, how do you traverse that gap from where we are to where we want to go, which is a hotter sector? And my advice is to think about what differentiates you within the existing category, like whatever exceptional capability it is that allowed you to, let's say, conquer the display market or the native market, and then figure out if and how that translates to CTV. So let's say what made you outstanding as a display SSP is your creative capabilities. Can you take that creative DNA and that IP and then bring it into CTV and then compete in the new market on that basis while also maintaining that narrative thread from the past to the present to the future? Because then your message becomes more credible. Like people are like, okay, yeah, we don't think of this as a CTV company, but we do think of it as an exceptional creative company. And so we could see how they're taking their creative chops from native and bringing it into CTV. I think that is sort of the way I would think about that problem.
Yeah. And again, it goes without saying that this problem should actually translate into like real world traction and solve the problem for customers. But the question of like, how do I have a cohesive narrative around the evolution of a company is super important. When you were saying that, kind of like Lumascape logos came to mind. An example of a company that's done that, I think, really well across, multiple eras at this point is Cargo. I don't know how familiar you are with Cargo, but I think Cargo is like a 25-year-old business and got started in the very, very, very early days of like pre-smartphone mobile. They have been able to, I think, do a good job of maintaining like what is their core. Ironically, it's around like creative and formats and brand building. And I think they've done a good job of like through every single era being able to continue to grow and evolve, but maintain that DNA. And Cargo's got, I think right now, like an incredible CTV business. and, works with a lot of like premium broadcasters and premium publishers on unique ad formats. And that's something that they did, over the mobile era, the programmatic era, and continue to be a strong business. So there's precedent that this can be done.
Yeah, I think there are a few different companies that would come to mind for most people that sort of follow that trajectory.
Yeah.
And yeah, they would be one in that category. So yeah, I think that is like, to summarize our thinking, I think this is a real phenomenon, right? There is some wariness of ad tech. If you are a founder or an executive and you're in this position, one thing is to be aware of that, but not be afraid of it, to make the case both for the results that the ad tech market has driven to date, but also to argue that it's only getting better. And there are signs of that, both in terms of the amount of enthusiasm within our industry, but also the support outside of ad tech specific investors, which Eric named, to also look at the leading AI companies, right? OpenAI embracing ads, and the inevitability that ads will subsidize those products for hundreds of millions of users who don't want to pay for them, but also to really familiarize yourself with the Viant narrative I espoused, and to make the case for our industry and for the increased efficacy of advertising and ad tech in the AI era. So that, that's one, is to make the case for the industry, and specifically with AI in mind. And then the second thing is to ground any story you're telling in a synthesis of the real strengths of your company, like the demonstrated traction and differentiators, while also thinking about where the market is heading, right? And to sort of tell a cohesive story about where you've been and where you're going that relies on those differentiators, while also explaining how those differentiators will translate into a bigger future and a growing market, which applies whether you're doing fundraising or whether you're just doing good old marketing and sales.
Yeah, really, really well said. I might go into the why now. If you're a new company, right, and you're fundraising and it's like seed or Series A, and you're an AI kind of like first AI native company, some of the things that I've been thinking about and playing with have like, a couple of points here. It's first, if we think about these platform shifts that have happened in the past, search, mobile, social, even within ad tech, programmatic, they've historically created like new category leaders. And you can point to that. And I think there's precedent for this. So it's like, A, like shifts tend to favor the new. B, if this is a new shift, part of why that's the case is that incumbents typically are burdened with like legacy tech, legacy practices. They can't move as fast, right? So it's like, why do you believe that, there's an opportunity for upending? And then in this kind of era that we're in today, AI native companies, they can do this by like raising less money and being able to move fast and having a different business model. So inside of this whole, like, why investors should believe today, and particularly kind of be leaned in on, an AI native, AI first ad tech company, there's a lot of, I think, precedent to favor that in moments like this, new companies win.
I think that's a good note to end on.
Thank you, Joe. We'll see you next week.